Hi again, welcome back. In today's session, we're going to take a look at foreign exchange and foreign exchange as it affects our investments in markets. During this session, I'm going to give you an introduction to foreign exchange, and there's no way that I could really talk about today's session in enough detail to make you an expert, certainly not in the next 40 or 50 minutes. But we will have an overview, and I'll give you some additional resources to discuss later. One of the key resources for the session today will be the course textbook, the Solnick-McLevy textbook. In particular, I think Chapter 2 and 3 provide a good background into some of the fundamentals of foreign exchange, and also something we'll talk about called parity relationships. I think one of the things that we find today, especially taking a look at the broader view of foreign exchange on the internet, is that everybody says that they're an expert. Everybody says it's possible to be an expert and to make profits from trading foreign exchange. I don't know if that's true, but I sincerely disbelieve that. I think that foreign exchange is something that we can partly understand, but it's subject to a lot of volatility that comes from incomplete information and irrational trading, some of the things that we describe as noise in the markets. What I can help you with today is not so much being able to say that the rate for the Canadian dollar to the US dollar will be at a certain level 3 weeks from now or 3 months from now, but I can help you to understand some of the explanatory factors that are going to help you to understand that. So in today's session, we're going to take a look first at some of the fundamental approaches. Things like how do we understand the idea of purchasing power parity and the law of one price, essentially a fundamental valuation approach. We'll take a quick look at how the government's balance of payments, as affected through the fiscal policy of the country, are going to affect the exchange rates. We'll also take a look at an asset market approach. So this is going to be the quick overview of some of the fundamentals, but then we'll take a very, very short look at how governments affect exchange rate movements through their policies, and also we'll look at the broader economic overview of things described as parity relationships. This session, as I said, is going to be a very brief introduction. When I talk about this during our international finance course, it usually takes me about 4 lectures at least to get through this material, and even then it's considered to be an overview. But let's get started. Essentially, when we talk about fundamental value based on relative purchasing power parity, and we're going to go into that in more detail a little bit later in today's session, essentially we're saying that understanding the value of an asset based on its relative value across 2 markets is something that is possible, but it's not easy. Understanding these relationships essentially is something that we claim to be able to do in real time, but it's only after years of perspective that we truly understand what was really happening. We see that corrections are sometimes necessary in our understanding of how to value things. How to value, for example, something like a car. Okay, well, a car clearly gets you from A to B. It's a manufactured goods. It costs so much to build, and so clearly the value is going to be at least the sum of the value of the raw materials, plus some of the standard value added. But also, when you think about it, when you're buying a car today, it includes certain other things. They're intangibles that are built into it. Historically, we've seen things like that are very fundamental, like the image, the lifestyle, the status that comes with owning a car. We also have got now, increasingly, quite a lot of service products that are added into that vehicle. So the actual value is going to depend on how much value in use we assign to each of the parts, each of the things that we're buying when we buy a car. So sometimes we have to make corrections to learn how to price things like the services that are embedded in a manufactured product. We can do that, and the correction will eventually take place, but it might take several years for us to identify that difference. And so we do have several different models, not just the purchasing power parity model. You can see how this kind of adjustment has happened in the past. For example, from the Solnick textbook, we have an overview of the relationship of the yen to the US dollar over a period of time. Starting off around 1972, going through to 2006, the value of the yen essentially depreciated against the US dollar. And so we can see, starting off at 300, right through to 1978, a decline. And by 2006, they're about 120 yen to the US dollar. At the time, purchasing power parity theory was essentially based on the value of manufactured goods. It said that the value of something and its value according to the equal value in use across two markets was identified by that top line, this dotted line that we see. It's kind of the broken dotted line that rose and then fall. And that's what we said that the value of the yen should be, at least according to our theory. By 1978, I guess, they revalued, or they reassessed the way that they were measuring value, and it said, well, actually, services are something that will be part of every product that we buy. And so as a result, we have to learn how to effectively value that service. Let me give you an example of why that might be important. If I'm living in the United States and I'm looking for a certain service, that service is, well, for example, a restaurant meal. And my restaurant meal cost me $20. Well, a restaurant meal that gives me the same amount of value in another market might only cost me $5. And so my buying power is distorted because of the differential, not just in the pricing of manufactured goods, but the pricing of services. So somebody makes $10,000 a year in one country might be living a lot better than somebody who makes $10,000 a year in another country. That's one of the reasons why we define middle class so differently from one market to another. So making that kind of an adjustment for standard of living based on the consumption of services and rebasing the formula, we see that the new parity relationship and the new predicted value of the yen is represented by this bottom dotted line, which is essentially pretty close to realistic. In fact, it even suggests that the yen should be able to fall further. Our balance of payments approach is a second approach, and essentially that takes a look at the behavior of governments. Governments generally are about 50% of the total economic activity within a country. That means the spending on the military, the spending on infrastructure by governments, but also social service provision, including things like healthcare in most countries, is going to be within the area of government control. How much the government spends, how the government controls things like the exports and the imports will also make a difference. So essentially, balance of payments. If accounts are held in a perfect balance, then there should be no need to change currencies over time. The things that make up our balance of payments, or that make up the national accounts of countries, include things like our import-export trade. That's the current account. Financial account, movement of currency across countries. The capital account, the movement or the investment in securities, and official reserves, so basically what's ever left over and held as foreign exchange reserves by that country through its banking system. An imbalance in one of those accounts could lead to depreciation or appreciation, increase or decrease in the home currency. We get information about this by taking a look at national accounts, and national accounts are created by looking at things like the invoices or bills of lading that are transmitted through the customs authorities, central bank statistics regarding the changes in currency balance, and things like the bank reports of large value transactions. The four things that we've identified as being the components include our current account, the capital account, financial account, and our reserve account. Of these, the largest single account is the first one, the current account. In this example, we can see the effect on the US to yen exchange rate over the period from 1974 to 2006, I think it was we were looking at before. The yen took fewer yen to buy a dollar. So essentially, we see an appreciation of the yen during part of the period and a depreciation of the yen in other parts. This was partly determined by things like the change in the US to Japan exchange, or the current account. So that the paired current account, here you can see in the early years we have the US having a surplus, exporting more goods to Japan than the import from Japan. So the gray colored bar is the current account. There's a bit of mixed behavior, and we see the depreciation of the yen during this period. But clearly, after a point, into the 1980s, Americans are consuming more things from Japan than they're exporting. And so they're using US dollars to buy yen in order to buy those Japanese products, and it is helping the yen to appreciate. But offsetting this, we have an increase of investment in the United States by Japanese. So that's the financial account. So Japanese government, Japanese banks buying US Treasury instruments, Japanese investors buying US bonds where they're able. And so we see offsetting the large current account deficits, we have financial account surpluses. So both direct and portfolio investment in the United States is increasing. And that means that the overall effect, the balancing number or the residual, is this very small box. And essentially that's the reserve account. That helps things to balance. And essentially says that the US was drawing down its reserves of yen during this period. But at a certain point, because of the increase in financial investments, saw a rise in its financial accounts. So essentially, we've got a type of a balance, but a forced balance through the sale of investments. So that's a very quick introduction to the idea. And when people talk about about balance of payments and the effects, essentially governments can affect the foreign exchange by creating an environment in which trade is going to be more attractive, where we can sustain large trade deficits over time, and where that's partly going to be balanced by the financial accounts. Another method is the asset market approach, our third method. Essentially, it claims that the exchange rate is the relative price of two currencies determined by expectations about the future. And it's not going to be determined simply by trade flows, and it's not simply going to be affected by parity relationships. Essentially, it says that information, surprises about the economy, about future economic prospects, would affect the exchange rate. And there are several types of news that are likely to affect the exchange rates. Things like the price of oil, for example, may have a substantial effect on exchange rates. Here's another example. If we have a sudden, one-time, and unexpected increase in the money supply because the central bank has decided to create cheaper money. It's going to reduce the interest rates, make it easier to borrow, and so there's going to be an awful lot more cash entering the economy quickly. More money without more things to buy essentially means that we're either going to have a lot of imports, or we're going to create inflation. And without access to import markets, that only means inflation. So our long-run exchange rate is going to be affected by the depreciation of the home currency, so the purchasing power parity is effectively maintained. In other words, if we expect a lot of inflation, our ability to buy stuff is going to be reduced. And so that means that the effective value of our stuff will be less, and that means the value of the dollar has got to fall. So we're concerned about, in this case, things like inflation differential. Now, it doesn't always work perfectly because quite often prices don't change right away, because the people that are willing to buy in that market will decide that it's not going to be a good idea to buy today. We'll put it off, and so we don't have complete pass-through of the exchange rate differences by manufacturers. So we describe that as sticky goods prices. So there may be an immediate drop in the real interest rate, but the depreciation of the currency is more than that implied by purchasing power parity. Here we have a simple, ordinary supply and demand chart that takes a look at the price and the quantity of euros in the market. If we have got an implied demand for euros from American consumers, people that want to buy euros in order to exchange euros for US dollars in order to buy goods that are priced in euros. And the supply of euros is determined by the central bank. A shift in the a constant demand, but a shift in the supply means that we're going to end up with an excess supply of euros at the current exchange rate. And that may be sustained over time because of sticky prices, but effectively in the long term, we would expect to see the full pass-through of that to the consumers, so that eventually the value of the euro would depreciate against the US dollar. The value of the dollar would depreciate against the euro to 125 to the dollar. Governments are important. Governments have the ability to affect exchange rates substantially, and they do this indirectly and directly. Some of the things that can affect the country's currency, some of the things that may be at least partly under the control of governments, differences in national inflation rates. The ability of the central bank to create or reduce inflation is largely a mechanism of monetary policy, and we'll discuss that a little bit more later. So changes in the effective real interest rate, not including the inflation, may also be part of that. In other words, how willing are people within the country to defer consumption into a further period in order to earn a bit more interest. Differences in the rate of growth in the economy. Higher growth implies strengthening of the economy in the long term, so that may be important as well. Also, things that make it easier to invest, both for domestic and international investors. So if we open up the market, deregulate, that allows a lot of new money to enter. We have people perhaps increasing their investment and moving away from consumption. Also have foreign investors entering the market. That too could affect the value of currencies. Direct government influence happens through two mechanisms. The influence of the central banks, which are usually not directly controlled by governments, but are certainly influenced by them. So monetary policy, expansionary monetary policy, increasing the amount of currency in circulation will lead to a depreciation of the home currency. Higher interest rates and a more restrictive monetary policy will lead to an appreciation of the home currency, because it looks like we have very strict control of inflation, and we're maintaining the integrity of the currency, often at the expense of domestic growth. When we see in the United States the American president complaining about his central bankers being too restrictive and not lowering interest rates fast enough, it's because if the central banks did increase the amount of money that was in circulation, it would make it easier for the economy to grow, but the central bankers are more concerned about inflation than growth, so they say no. And to a certain extent, they can resist the politicians because they are substantially independent of government control. Now, the government itself makes plans about spending. It maintains a surplus or a deficit in government spending. It can raise taxes and pull money from the economy. All of this is about the fiscal policy. So a restrictive fiscal policy would slow down economic activity and inflation. For example, they'll cut government spending. They'll maintain a very strict control of government spending. That would certainly be more restrictive. A more expansionary policy means the government is spending on infrastructure. They're maintaining full employment in government jobs. Perhaps they're running a deficit because the tax levels are too low. And so that is more of an expansionary fiscal policy, and it would have the reverse effect, but of course very, very important long-term consequences. Now, as well as monetary and fiscal policy, governments are involved in foreign exchange markets because in most cases they simply allow the market to determine what the rate should be. But that's not always been the case, and in some countries still governments do intervene in the actual exchange rates. We see in many different countries around the world many different and interesting examples of this. We say of Canada and the United States that we do attempt to maintain a fully flexible and floating exchange rate. In other words, whatever the Canadian dollar is at today versus the US dollar or the euro or the pound or the yen, it's that way because that's the supply and demand conditions for each of those exchanges. That's a fully flexible exchange rate. Now, in the past, central banks have intervened. If there's a major shock to the system, perhaps the central bankers will buy back their own currency to reduce the supply of available Canadian dollars and maintain the value to stop it from falling too much. And if another country has got a problem, the Canadian government, the American government, other developed countries will also jump into the market to buy up some of that currency to help to stabilize a friend's currency. And so we say that is still a floating rate system, but it's a managed float. We have also got, at the other extreme, we have fixed exchange rates where the rate is set versus another currency. Great examples of that have included things like the Hong Kong dollar to the US dollar. Over a very long period of time, the rate was exactly the same, and it didn't change. And we knew that the Hong Kong government could support that because the monetary authority in Hong Kong had such a large amount of foreign exchange reserves that they could afford to buy up any surplus dollars or surplus Hong Kong dollars and stabilize the currency. And they could do that for probably years at a time without using up their supply of foreign exchange reserves. Another approach is to say that this is the rate at which we're going to maintain our currency. This is our peg, and we're going to maintain that peg, and we're going to reevaluate it on a periodic basis. So it's not formally fixed, but it is informally fixed. So that would be more of a pegged exchange rate. Now, the problem with any kind of a managed exchange rate is that it only works as long as the country has got the resources to back that particular policy. It provides a lot of stability and certainty for exporters and importers because they know for sure what the exchange rate is going to be a week or a month down the road. However, if the country's policy is out of line with that of the other country and we have a lot of continuous pressure, eventually companies fall off their peg, or their fixed rate can no longer be supported and they have to have devaluation or revaluation. Now that takes us to the next area, parity conditions. Parity conditions essentially say that we expect that certain things are going to be the way that they are for a reason. We have about 4 different types of parity conditions, the first couple of which I'll go into in more detail today. The other 2 I'll briefly mention towards the end of today's session. Parity conditions are the conditions that suggest that if a currency is at a certain level, it will stay that way, it'll stay at parity unless something comes along to move it. In other words, there's a rational basis for the value of currencies. And maybe there'll be a temporary twitch where we'll move away from that condition, but as long as the fundamentals stay the way they are, we should be able to predict exchange rates. Of course, we know that there's a large amount of both noise or misinformation in the market, and there's also a lot of just natural volatility. And so these conditions never quite hold the way that the textbooks predict them. So they don't always hold to be true, especially when we take a look at the real world. We saw in the example of the Japanese yen that over a period of time, that the actual yen to dollar exchange rate never quite matched what we expected it to be, even when we reevaluated the conditions. Even when we rebased the purchasing power parity, we still had mispricing of the yen. Certainly, economists would say the problem isn't with the theory. The theory is perfectly fine, but it's interpretation and application that is the problem. So, yes, the theory still holds. It's still the best that we've got, but on a day-to-day basis, the theory doesn't match the real world very well at all. Essentially, we talk about purchasing power parity, and another term for this is the law of one price. In other words, if something gives us a certain benefit, it should be of equal price across markets. If I want to buy a General Motors pickup truck, and it costs me $30,000 in Canada, in Canadian dollars, and I look in the United States and I see that converting my Canadian dollars for US dollars makes it cheaper in the United States, that doesn't make any sense at all. Now, there may be fundamental reasons why that's different. Maybe it isn't exactly the same product. Perhaps there are differences in warranty, there are differences in standards of construction, perhaps the emission controls are different, the kilometers versus miles or whatever. But essentially, something that gives me 30,000 Canadian dollars of benefit in Canada should cost 30,000 Canadian when we see it in another market. And that's not always the case. So if the product can be, and this is the theory, sold in two different markets and there are no restrictions on the sale, the transportation costs are very, very small, then essentially the product should be the same in both markets. And we know this isn't the case. There's always a bargain to be found elsewhere. Like in this old cartoon from a British newspaper, people always find a bargain in another market. Let's go to Thailand because it's really cheap. We can live there on the beach for $10 a day. And essentially, that condition tends to hold over a long period of time, and that's partly because there are going to be differences in infrastructure costs, and there's political uncertainty, and all kinds of interesting reasons why we might see a persistent imbalance in price. Probably the most famous example of purchasing power parity comes from an article that was originally produced in The Economist and has been revised over and over again over the years. And it's called the Big Mac Index. Essentially, the Big Mac Index proposes that the ubiquitous standardized hamburger that you can buy in Nanaimo or Vancouver or Calgary or any other place in the world really should essentially cost the same price because it gives you the same benefit. Now, I could talk about this comparison and all the things that are wrong with that for about an hour, but I won't do that today. But essentially, the logic of the argument said that if a hamburger costs a certain price in New York, then accounting only for the spot rate difference, the exchange rate difference in the currency, that hamburger should cost the same price everywhere. And when we take a look at the results in the Big Mac Index, we see that in the United States, Big Mac that would cost you $4.20 in the United States, accounting for foreign exchange difference, should be worth $4.20. $4.20 times the spot rate should exactly come out to that number, and there would be zero difference. All of these numbers should be right on that line. Essentially, it says, if we take a look at a lot of different countries, if we look at Switzerland, the Big Mac price in dollars is $6.81, or 60% overpriced against the US dollar. That suggests that the Swiss franc is significantly overpriced, and that over time it should fall so that we have zero difference. The Norwegian krone, Swedish krona, Brazilian real, and so on, all of these currencies are significantly overvalued. On the other end of the scale, if we look at India, it only costs $1.62 for a Big Mac in India, although I believe there's some kind of difference in it's called a Maharaja Mac, not a Big Mac, in India. that product for $1.62, translating that into rupees, well, clearly it's not the same as $4.20. It suggests that the rupee is 60 or 70% undervalued. Now, of course, we look at some of those markets, and if you're a sophisticated traveler, you know that Big Macs aren't exactly the same in each country. They're not produced for the same benefit. Sometimes a hamburger is more than just a hamburger. In some places, it's a status symbol because you're going out to an expensive international chain. Some places there's security and other services that are essentially bundled in, that they're nice restaurants or they're not nice restaurants. And so those things might also cloud our comparison. People have tried other things like Coca-Cola or French fries to use as an index. A few years ago, I wrote a paper taking a look at using frequent flyer miles to determine the difference in these kind of parity relationships. So this approach is certainly an interesting one, but not a perfect example. The primary principle for any kind of parity relationship, in particular purchasing power parity, is that prices will equalize over time across market unless we have something like taxes, tariffs, transportation costs, different standards that are going to throw those those parity relationships out of balance. So if everything else was equal, comparing prices would only require a conversion from one currency to the other. In other words, the yen price of a Big Mac is equal to the dollar price times the spot rate. And if the spot rate's wrong, then we have the wrong price. The spot rate shouldn't be wrong, so we can adjust. We can play with the spot rate until we end up with a perfect comparison. So this is a very simple idea, a very simple overview of what we mean by the parity relationship. If the law of one price were to be true for all goods and services, then purchasing power parity could be found from any individual set of prices, whether it was for cars or for houses, perhaps for any kind of good that was transferable across borders. Comparing the prices of identical products, we could determine the real purchasing power parity price that would exist if markets were efficient. And we call that the absolute version. We'll look at the relative version in just a minute. The actual evidence, well, we see that this particular approach doesn't hold up well in the real world for a variety of reasons. Part of this is about the services thing that I mentioned earlier. If you want to get a haircut may cost 10 times as much in a developed market, even more, than in a developing country. So the actual part of our income that has to go into services like haircuts and restaurant meals is going to be a smaller amount. So in other words, our wealth is defined very differently from one place to another. Some things really do compare well across borders. Things like an iPad or a standard laptop computer are essentially standardized, except for maybe the plug, across different markets. And if they can move across borders, then we'd expect to see a real parity relationship. And that one's true. I found if I travel around the world and I see there's a computer that I want to buy in Canada, I'll find it's pretty near the same price in just about every country that I travel to. A little bit of difference. And as I travel around the world, quite often I end up buying the thing from the place where I came from, because except for maybe a sales tax or two, there's really no difference worldwide, even accounting for the foreign exchange difference. There may also be other barriers like shipping costs, tariffs, quotas that can lead to a permanent and sustainable deviation from purchasing power parity. So essentially, these things provide us with a benchmark, a place to work from the theory and try and interpret the real world. And that's essentially what we try to do. The absolute version we know doesn't really work because we do take a look at that Big Mac index year to year to year, and we always see Switzerland on the top, and we always see India on the bottom, where we'd expect to see the rupee appreciate and the Swiss franc depreciate, and it just doesn't happen. So instead we take a look at something called the relative purchasing power parity, the rebasing that we used at the very beginning when we took a look at the Japanese yen. Essentially, this approach holds that purchasing power parity doesn't help us to understand what the spot rate is today, but the relative change in prices between the two countries and their currencies would be over time, and perhaps over a long period of time. So if the spot exchange rate between two countries starts off in equilibrium, any change in the differential in inflation between them, that's going to be the important part, is going to be offset over the long run by an equal and opposite change in the spot exchange rate. An example really helps. For example, from another one of my textbooks, I just happened to have this chart, and it said, here's the percentage change in inflation. So if inflation is going to be higher, if we have a 2% higher inflation rate in our country than the other country, we're over here on the right-hand side of the chart. We would predict that our currency, our own currency, would lose about 2% of its value over time. Not necessarily exactly 2%, but about 2%. And that's our prediction. And in this case, if we're looking at something like the Swiss franc to the US dollar, if Switzerland has 4%, if the United States has, Switzerland has 4% less inflation, then we'd expect to see the Swiss franc appreciate against the US dollar by about 4%. Essentially, this kind of approach we see tends to be true. If you take a look at countries with very low inflation rates, we tend to see their currency appreciates against the others. And it doesn't even have to be the real inflation rate, it's just our expectations, our predictions of inflation. So if we think we're looking at a period of high inflation that's coming up in the United States because of the increase in government spending during the pandemic, then we would predict that the US dollar, with higher inflation, would lose value against other countries, other currencies that had lower inflation. And that's essentially one of the things that we're all thinking about right now. What's going to happen next? Our experience with the empirical or the real-world testing of purchasing power parity hasn't proved that either the purchasing power parity or the relative purchasing power parity works consistently over long periods of time. It's not a great predictor. So it holds up well in the very long run, but it's not going to be useful for trading from this week to the next. The theory also holds up better for countries with high rates of inflation and for underdeveloped capital markets. If we're looking at individual currencies versus another, we need to understand the relative purchasing power parity. That gives us a better picture. And our objective is to discover whether the exchange rate is overpriced or underpriced in terms of parity. And the problem is also understood best through exchange rate indices like the nominal effective exchange rate index. In the example that we see here, again from the Solnick textbook, I believe, we have the effective exchange rate indices. Here 100 is our baseline value. And so you can see the United States appears to be overvalued throughout the 1980s, and then appears to be undervalued through the 1990s, and then overvalued again, and perhaps undervalued moving into the future. Very different experience from Japan, which was significantly undervalued moving into the 1980s, but through the 90s was significantly overvalued and perhaps is undervalued today. So when we're looking at and comparing different markets, we have a pretty good idea in the medium to long term what we expect to see happen to those currencies. And an overvalued currency will move to fair valuation, and undervalued currency will appreciate. One of the problems, and we mentioned stickiness earlier on, is that quite often companies can't pass full exchange rate issues through to their customers. They can't pass the full cost through to their customers all at once, because they know that for certain goods we are likely to change suppliers if there's going to be a big jump in prices. So there's that stickiness in prices, and that leads to something called exchange rate pass-through. Essentially, that explains why a country can deviate from our expectations based on parity relationships for the short to medium term. So this particular term is the degree to which the prices of imported and exported goods change as a result of the exchange rate changes. Purchasing power parity suggests that our exchange rate changes are all passed through, and in fact the theory suggests that they're passed through immediately. Empirical research during the 1980s suggested that is not necessarily going to be true. For example, if we take a look at a car manufacturer, they can delay passing through the full cost increase that comes from the exchange rate differences in foreign countries in order to maintain the market share. They've already paid for the dealer network, they have their dealers to support, they have their supply chains to support. There may be government restrictions, they may have quotas that they don't want to give up, and so they will sell perhaps as low as cost or perhaps even below cost for a period of time. Say that the pass-through can be partial because there are many ways that the company can absorb the effect of an exchange rate change. Perhaps they change their supply chain and do a little bit of something we call natural hedging. The price elasticity of demand is going to be the thing that's important. If we raise our price by 10%, will we lose 10% of our customers or only 5% or 25%? That is what we mean by the price elasticity. So our own price elasticity of demand for goods is going to be the important thing. Here's an example that might help you to understand it a little bit better. Here we've got a measure of pass-through, and you'll see the the main equation here, we have a company, BMW, that wants to sell its cars in the United States. And at the time that we look at this, the dollar price of a BMW is going to equal the euro price of the BMW times the US dollar to euro spot rate. The price is $35,000 in Europe. That's the euro price for the BMW. And the exchange rate is 1.000 US dollars to the euro. In other words, a 35,000 euro car costs 35,000 US dollars. Now, within the next year, if the price of the euro appreciates 20% versus the US dollar, and the exchange rate goes from 1.0 to 1.20 US dollars to the euro, the price of the BMW in the US market, substituting that 1.2 into this equation, means that the price of the BMW should go up from $35,000 to $42,000 in 1 year. If you were thinking of buying that car, you saw a $7,000 increase in 1 year for the same car, you wouldn't be very enthusiastic about it. You might look for other alternatives. Perhaps it would be a good time to look at maybe the Japanese car or an American car as an alternative. So what BMW does when they look at this, they say, okay, well, let's tone that down a little bit, and we're going to increase the price to only $40,000. We'll absorb $2,000 worth of that difference. So the effective difference would be, the effective amount of pass-through essentially says that here we've got our $40,000 car at the new price divided by 35,000. It implies the new euro to the dollar exchange rate would be 1.14, 14% increase, not a 20% increase. So only about 70% of the exchange difference, the spot rate difference, is going to be passed through. Another effect is the effect of interest rates and exchange rates. And before we say anything more about interest rates, we have to remember that there are always two components. According to the Fisher theorem, Fisher effect, the Fisher theorem states that the rate of interest that we see, the nominal rate, is equal to the real required rate of interest you need to forego consumption, plus compensation for your expected inflation. So essentially, the nominal interest rate, I, is equal to the real interest rate plus the expectation of inflation, the value that we use for pi here. Essentially shows that this is a clearly identified and well understood relationship that we especially see if we're taking a look at short-term financial instruments like treasury bills. The relationship between the percentage change and in the spot rate and the differential between interest rates is known as the international Fisher effect. Essentially, it says the spot rate should change in equal and opposite directions, equal amount and opposite direction to the difference in the interest rates between the two countries. So essentially, we start off by looking at the difference. Here, a difference in the interest rate, the nominal interest rate between the US dollar and the yen, is going to be equivalent to the change in the spot rate over time between period 1 and period 2. So the spot exchange rate for the dollar to the yen, the spot exchange rate to the dollar to the yen, the spot exchange rate dollar to the yen in the today, next year, divided by next year, or today, tomorrow, and tomorrow. So essentially over any period of time. This is a measure that defines what that says that the spot rate difference is going to be partly determined, perhaps totally determined, by the difference in the, you got it, in the inflation. Now, so part of this is also down to things like the forward rate. Remember, we talked about spot rates and forward rates in one of our earlier sessions. Essentially, the forward rate is the exchange rate for settlement, for delivery at some point in the future. So if I ask for a forward rate for 90 days, essentially I'm entering into a contract to change so many dollars for so many yen in 90 days' time. We can also say a forward exchange rate agreement between currencies says that the rate of exchange at which the foreign currency will be bought forward or sold forward at a specific date in the future. Just a different way of saying that same thing. I used an example from a website from the University of British Columbia. A professor there by the name of Werner Antweiler generally keeps up to date, although not at the moment, perhaps because of the pandemic. He provides a service where essentially he talks about different dimensions or different aspects of exchange rates. In particular, his focus is the Canadian dollar to the US dollar exchange rate. And from a variety of sources, he's drawn together the information that says that on this date, and this information is from 2014, the the spot rate for the US dollar versus the Canadian dollar was 93.91. That was the rate that you got, the mid-market price for the exchange rate on that particular day, Wednesday, July 9th, 2014. For delivery in 1 month's time, that same exchange rate would be 93.84 cents, or in basis points, 0.9384. So there's actually going to be a 7-point difference between 91 and 84. That's the premium. And the premium expressed as a percentage will be negative 0.91%. And so he's done that for 2 months, 3 months, 6 months, and so on. And you can see a general trend here. If you want that Canadian dollar delivered in the future, it's going to cost you an awful lot less. So a Canadian dollar would only cost, US dollar would only cost 90.81 US cents in 5 years' time, according to these predictions, which is a 310 basis point difference between the original spot price and the 5-year price, or 0.67% over 5 years. And so essentially says there's a discount for future delivery for the Canadian dollar, and just shown on that chart. You compare that to the way things look now, or maybe not now, but more recently, in March of 2019, the spot price on that particular day was 75 US cents buys 1 Canadian dollar. There's still a 7 basis point difference, 7507 for 1 month delivery, but it's a positive number, and it's positive 7 points. In terms of percentage, that's 1.09%, and we have the same kind of relationship that over time it looks like the Canadian dollar will appreciate versus the US dollar over time, so that in 5 years' time it will only take 77 cents to buy 77 US cents to buy 1 Canadian dollar. And so there we see the premium version of that same thing. Now, as we mentioned in class, there are many sources for this. If you're using a Bloomberg terminal or the Thomson Reuters or Standard & Poor's IQ service, you can get up-to-date live information about these prices. There are, however, several free resources that are available, usually or typically time delayed, so the information isn't quite as useful, but certainly useful for our purposes. Among these, we have things like investing.com or fxstreet.com. And these resources will provide us with information like the publicly traded forward rates. In this particular case, we have a forward rate for the US dollar to the Canadian dollar, provided a couple of days ago. And this particular table gives me the information about quoted forward rates from everything for overnight or ON contracts right through until 30 years delivery in the future. The prices are expressed as bid and ask. So, for example, if today the spot rate for the US dollar to the Canadian dollar is about 74 cents. The bid price on this, or the price at which they're buying currency, would be a difference of minus 1.5530, which means that the forward rate, the overnight forward rate, would be something like 739 8.45. Similarly, for the ask price that's quoted here as well, that would be 7400 minus 0.064, or about 7399.94. So that is essentially what we mean, or that's how we understand these forward rates. And they're determined by buying and selling on markets. And as we've seen with our chart information and courses that we've done, like MBA 573, a candlestick chart will give us general information about what the market thinks about these kind of things. And you can see for the the US dollar to the Canadian dollar at a current quoted price of 135.75, that was the rate on the day that I downloaded this, that it had been trading during August of, from August 2019 to today's rate. The typical price, one US dollar would cost 135.75 Canadian dollars. It would trade in the range of about 132. Then sometime during March or April, I think it went up to a high of 147. In other words, the Canadian dollar lost a lot of value with all the volatility in the market, and today's price is down to 135.75. So that's the spot rate. And we watch the spot rate, and from that we can interpret all of the forward rates. Just thought I'd mention that, since it is a very useful resource. Now, interest rates and exchange rates are related. Now, the forward rate that we just saw comes from the market. It comes from the beliefs of people in the market. It's not a perfect expression of any of these parity relationships, but it does provide us with some guidance. We could also say that the forward rate can be calculated by taking a look at the differences in interest rates. And for any specific maturity, we can calculate this by adjusting the current spot quoted price by the ratio of the euro currency interest rates of the same maturity for two other subject currencies, or for any two subject currencies. Now, it's important to note, by euro currency, we mean any bond, typically government bonds, but also issued by major corporations, that is traded outside of its home market. So it doesn't have to be a dollar traded in Europe, although really that's where it started from. So dollar-denominated bonds traded in Europe were called euro-dollar bonds. Essentially, Canadian bonds traded in Europe are also called euro-dollar bonds, but a yen-denominated bond that was traded in the United States is still called a euro currency bond. Go figure. So that's what we mean by euro currency interest rates, the rates on bonds, and typically very stable and credit quality, high credit quality bonds. So, for example, if we have a 90-day forward rate for the Swiss franc to the US dollar, and want to find the exchange rate for that 90-day forward rate, we can get it by multiplying the current spot price of Swiss francs to the dollar, the S of SF to the dollar, by the ratio of the 90-day euro Swiss franc deposit rate over the 90-day euro dollar, US dollar, deposit rate. And this is what that would look like in a formula. So if we want to figure out what our purpose is to find out what the spot rate is, what the forward rate is for the Swiss franc to the dollar 90 days in the future. We'll take today's spot rate for the Swiss franc to the dollar, and we'll multiply it by 1 plus the interest rate on the Swiss franc for 90 days, and divide that by 1 plus the dollar rate, the dollar interest rate for a euro dollar instrument for the next 90 days. Now, you can work that out in terms of a premium. We can figure out the forward premium or the discount that we just saw in our previous market example. We can work that out by taking a look at the forward rate for the Swiss franc is equal to the difference between the spot and the forward rate divided by the forward rate times 360 days times the number of days that we hold the investment. If it was 90 days, that would be 90 days in the denominator. And so that would be the case when the foreign currency price of the home country currency is used, if we're working this out in what we call the indirect terms. And here's an example of a chart that expresses that. So if we're taking a look, we're comparing the euro-dollar yield curve. The rate of interest on the on US currency is much higher than the Swiss franc yield curve. In fact, the difference is about 4%. So for a 90-day rate, the increase in the interest rate between the Swiss franc government bond rate and the US government bond rate is that premium of 3.96%. It's kind of like looking at the default risk premium that we saw on bonds. And so we would expect with a much higher interest yield, we'd expect to see the US dollar lose value against the Swiss franc, and our notion is that we'd probably lose it at the same value that the interest differential worked. And we'll come back to that in just a second. The theory that helps us to understand that is called the interest rate parity theory. Essentially, it says the difference in national interest rates for securities for similar risk, maturity, liquidity should be equal to but opposite in sign to the forward rate discount or premium for the foreign currency except for transaction costs. So ignoring transaction costs, essentially would say if there's a 3% premium for the US dollar versus the Swiss franc over 90 days, we'd expect it to lose 4% value. Equal and opposite sign. Now, you can kind of see how that works when you take a look at bond markets and the way that bond markets tend to work. Sure, countries have different interest rates, different base rates, but how does that affect the forward rate on their currency or the movement in the spot rate on their currency? In this particular example, we're looking at the money market, and we've got two currencies. We're sticking with the Swiss franc, and we also have dollars. If you had $1 million to invest, and you could invest it in US dollar denominated instruments, those US bonds, the interest rate per year, let's say it's 8% per year. And so if you're going to hold on to it for 90 days, that means you would earn 2%. Put your money into your $1 million into a bond for 90 days, earning 8% or 2% simple interest. Your $1 million would be worth $1,020,000. 1,020,000. You'd get a 20,000 gain at the end of 90 days. Now the alternative would be to put your money into Swiss francs, and the way you would do that is you would buy the Swiss franc today. The current price for the Swiss franc, the spot rate, is 1.48 Swiss francs to $1 US. And so that means your $1 million investment would buy you 1,480,000 Swiss francs. You deposit that money into a Swiss money market instrument, earning, in this case, 4% per annum or 1% per quarter. So you're only earning 1% over the 90 days. That means at the end of 90 days, 1.480 million Swiss francs would be 1.494.8 million Swiss francs. So that's how much money you'd have at the end. You would have earned less interest in Swiss francs, but here's the deal. At the end of 90 days, the forward rate, the rate at which you expect to be able to turn your money from Swiss francs back into dollars, the forward rate, well, the Swiss franc is appreciated. It's moved up against the US dollar. Now, $1 is only going to cost you 1.4655 Swiss francs. It's gone up from 1.48 to 1.4655. And that means if we divide 1.494800 by the new forward rate or the future spot rate, that means that the value of your investment would be $1,019,993. In other words, it'd be about $7 difference. And so for the purposes of this example, essentially we've said it doesn't make any difference whether you put your money into a low yielding Swiss franc investment or a higher yielding US dollar investment, because whatever you gain from the higher interest rate in US dollars, you're going to lose on the exchange rate. And we see this over and over again. We hear things described like the Japan carry trade or the euro carry trade, where investors will try to make more money by choosing the higher interest rate. Whatever they gain from higher interest, they lose by the exchange rate difference. So we say that this is not going to be perfectly enforced by the markets. There's no official mechanism that kicks in and says that these are exactly how the spot rates are going to work. There can be periods of imparity. There can be periods that when things are not going to be perfectly in balance. And if they were going to be out of balance, then there's a possibility for something called an arbitrage profit. There are two types of ways of describing investment. One way is speculation, because you're taking on a risk. Arbitrage implies a risk-free type of profit. And so arbitrage can be produced, but it becomes harder and harder to do because computers tend to push most of the arbitrage opportunities out of markets. If we do have an arbitrager, a person who is going to make the market work, and if you think back to the origins of this term, arbitrage is from the German arbeiten. Essentially, this is the person that makes the market work. An arbitrager calculates the differences, makes the investments that are necessary without taking any kind of a risk, and will eventually get a small gain as a result of that. An interesting example of this is called covered interest arbitrage, or CIA. And you will find this in just about every international finance textbook. In this particular case, if you're the arbitrager and you've got your $1 million, we have a euro-dollar rate of 8% per annum, and over 180 days, you can earn 4% interest. 8% divided by 2, 4%. That means an investment in this market would provide you with a $40,000 yield after half a year. Or you could put the money into, in this case, yen. So the dollar for the yen spot rate is takes 106 106 yen to buy $1. So 1 million turns into 106 million yen. Now, the yen is only yielding 4% per annum, 2% for 6 months. And so 106 times 1.02 gives me 108 million yen, 120,000. The forward rate for the yen's going to appreciate in value against the dollar as well. After 180 days, $1 will be worth 103 yen 50. And so if we divide 108 by the forward rate, that means that we see that there's a possibility of having 44,638 as our return. Now, this is just describing two different investment opportunities. The way that you would turn this into an arbitrage opportunity is this. We would not actually invest our $1 million into US dollars. We'd start off with nothing, and we would short. We would use a short position in interest rate futures in US dollars. That means we're going to owe at the end of this period $40,000 in interest, and then we're going to go long in the yen money market, and we're going to get a $1 million position converted into yen in the yen market. We're going to earn the interest rate, and so we'll earn 108, and then we'll have a total yield of the 44,638. So that's how much we're going to gain, and we're going to close our position and repay the 40,000 with our $44,000 gain, netting out $4,000 difference. And so that's a type of arbitrage. And again, I'll come back to another example of that in a second. An alternative would be to use some kind of uncovered interest arbitrage. Now, we said that the first version was covered because we matched a short position in US dollar interest rates with a long position in the yen interest rates, and so they were covered. Whatever we were going to gain in one, we lost in the other. In this case, investors borrow in countries, in the uncovered case, and currencies that have low interest rates, and convert the proceeds into currencies that offer higher interest rates. This was very popular in the United States in the 1970s. Investors in the United States would borrow money from US banks, invest the money in Europe, getting higher interest rates, particularly in Deutschmarks, because there were higher interest rates paid on the German instruments. At the end of the period, they would cash in their investments in Germany with the much higher interest yield included. They would then have to go back and pay back their US dollar bonds and find out that they had lost whatever gain they'd made in the European markets because of the rise of the Deutschmark against the US dollar. And we saw this in Japan in the most recent decade. So essentially we say it's uncovered because the investor doesn't sell the higher yielding currency or doesn't short them. Selling forward is another way of shorting them, and prefers to remain uncovered and accept the currency risk. So in this particular case, we'd say that we have an investor who starts off with 10 million yen. We'll start off with yen this time. And they borrow the yen at a rate of 0.4% per annum. Really low interest. In fact, now we even seen negative interest in Japan. And so at the end of the period, they're going to be liable to repay the extra, on 10 million yen, they're going to have to repay 40,000 extra in interest, so 10 million plus the interest. Now they take the $10 million, they exchange it at the spot rate of 120 yen to the US dollar. That means that their 10 million yen buys them 83,333 US dollars. Invest that in the US money market at 5% per annum over a whole year. They end up with a yield of a total yield, including the principal, of 87,500. Convert it at the rate in the future of, well, let's hope 120 yen to the dollar. That means that they're going to yield 10,500,000. After they repay the principal, they'd end up with 460,000 yen profit. Now, the reality is, well, this is a great idea in theory, and it does work on occasion when the arbitrages are successful. It doesn't. It's more of a speculation than arbitrage. It carries with it significant risk, so it truly is not arbitrage. It's more likely speculation. Essentially, all of this informs us about interest rate and interest rate parity. On the next slide, we'll take a look at some of the conditions for equilibrium between interest rates and exchange rates. And it's possible for us to temporarily be in a situation or a position of disequilibrium. But essentially, the pressures of time were going to push just about any disequilibrium position back into a type of equilibrium. Interest rate parity, like purchasing power parity that we saw earlier, essentially says that while we've got a condition of imparity, and here we can see if we've got a premium or a discount in the interest rates between two currencies, there's going to be pressure for the currency to appreciate or depreciate. So if we have, for our particular currency, if we have got a negative premium on our interest rate, if our interest rates are 4% below the interest rates that are offered in other countries, we'd expect to see our currencies appreciate by 4%. On the other side, if we have got a premium, we'd expect to see, if we have a 4%, or here we've got a 4.83% difference in our premium, we'd expect to see a decrease in the value of the currency. Now, what we have here is an imparity, so we're above that line. We're at a position U. And this suggests that over time, we're going to be forced back onto this line if we end up with a movement in the interest rates down to 4%. We could see a 4% parity, a 4% decrease in the currency because of that arbitrage, the uncovered interest or the covered interest arbitrage, or we could see an increase. We could see a maintenance of the premium, and we'll see a further fall in the currency to 4.83%. So eventually we're going to end up back on that line, that the position will be unsustainable because the arbitrageurs will be working by buying and selling, putting pressure on the currency to rise, or putting pressure on the central banks to change the interest rates. eventually we'll end up in a position of parity. So, kind of a final word on interest rates. Forecasters believe that forward exchange rates are a good predictor of future spot rates. They're not a perfect predictor, but unbiased means they're going to be wrong on the high side as often as they're wrong on the low side. So they're not always right, but they're equally wrong in both directions. Intuitively, this means the distribution of the spot rates in the future is going to be about the forward rate. The forward rate will be a good predictor. The market forward rate will also be a good predictor. So essentially, it doesn't say you can't make mistakes. It just means you have to be wrong equally in both directions. And you can see how this works in this diagram. If on a day the market believes that the forward rate, the F1, looking forward, is going to be a value like the one here, and we find the actual spot rate is a little bit higher, we were off. There's a certain amount of error. For the next period, we incorporate the new information that we've got. We make another prediction, and we say, okay, next period the forward rate is going to be a period something like F2. And we find that at the end of the period, the spot rate was wrong again. We've got an error. We make another prediction, and we say the forward rate's going to be at this value, and we're off again. We've made another error. The sum of the errors over time is going to cancel out. All the positives and the negatives essentially says we're equally wrong in both directions. The error is non-systematic, and so it really doesn't matter. We've got a reasonable predictor. Not perfectly right, but not systematically wrong either. That's an awful lot about parity relationships in a very short period of time. We can see that overall, our picture essentially tells us, kind of in summary, that we have several relationships that are going to be pushing currencies into some kind of equilibrium at any point in time. The first of these, essentially we saw, was the purchasing power parity. So purchasing power parity essentially says that if we have differences in buying power, so for example, if we have 4% lower inflation in Japan, we'd expect to see a rise in the yen because of purchasing power parity. What we also saw, there was something called the Fisher rate that says that inflation is also going to have an effect on interest rates. The nominal interest rate is made up of real plus inflation. And so a decrease in inflation means likely a decrease in the relative interest rates, in the nominal real interest rates. The relationship in interest rates we can see through the international Fisher effect essentially says that a 4% difference in nominal interest rates means that we'll see a 4% increase in the exchange rates, which essentially is the basis of relationship D, interest rate parity, which essentially says difference in nominal interest rates means the forward premium on the yen is going to strengthen. That's what we were talking about with the forward premium. And since we're saying that the forward premium is an unbiased predictor of exchange rates, in other words, not always right, but it is going to be on average a good guesser, it says the forward rate is an unbiased predictor of the future spot rate. A very complicated mix, and as we said before, at any point in time, none of these parity conditions are going to be perfectly in tune. However, it does give us a fundamental way of understanding how exchange rate movements work. So in this session, we started off by taking a look at the fundamental value based on relative purchasing power parity, a very simple way of looking at exchange rate or spot rate movements. We talked a little bit about balance of payments and the effect of governments. We had a look at the asset market approach. We had a very brief introduction to the role of governments with both exchange rate management but also fiscal and monetary policy. And we spoke about parity relationships and an extension of the parity relationships, how arbitrage helps to make some of those parity relationships, especially the interest rate parity relationship, work. A long session and also a very brief introduction to what is a very complicated subject. And I hope that this video has been a good investment of your time. Thank you very much.